Hi, everybody. Every once in a while, I get a question about why not just put all my money in the S&P 500? And it's a fair question because the S&P 500's been up almost 27% since 2023. But it's not something I'd recommend because it's rooted in a human frailty called recency bias. And so recency bias was effective as we evolved. As an example, if we were cavemen and living in a village and last night someone had seen a tiger around the camp, and tonight we started to hear some strange sounds, we might want to pay more attention to that than we would have if we didn't see the tiger the day before. But when it comes to investing, recency bias can be very harmful. It pushes emotional, incorrect decisions. When the market's low, we have a bias to feel like it's going to remain low or even go lower. And so people have a tendency to want to sell out probably at the exact time that they shouldn't. And the same thing happens when the market's high. People want to buy in and buy in and buy in when the market's going up. It happens every market cycle. As the market goes up, people pile into those high-priced stocks. And then when the market's down, they want to sell right at those market lows and lock in the losses. So instead, the alternative and the correct thing to do is to use rational, evidence-based decisions on what we do with our money. So I want to break it down to the S&P 500. The S&P 500 is the average of 500 very big companies, many, if not most of which you've heard of in the past. And I'm going to compare it to small company value stocks. And those are companies that you probably haven't heard of, most of them. You might have heard of a few, but most you won't know. So since the beginning of 2023, the S&P 500, as I said, was up about 27% through June this year. Small value companies have only been up about 10.5%. So if you look at that recent period, you're going to think, gosh, I probably should just go put my money in the S&P 500. Now I want you to look at this chart. This chart goes back to 2010 and takes it through 2024. The S&P 500 was up 521%. That's very impressive. Small value was up 402%, which is also impressive, but it's not 521%. So the S&P looks better. And that's what people are going to tend to want to buy at this point. But it's an illusion. It's recency bias. So let's go back and look at the prior decade from 2000 to 2009. So this chart is showing you that the S&P 500 lost 9.1% over that 10-year period. You were down for 10 years. Small company value stocks, they were up 219%. So, that's a dramatic difference. If you were back there now, you're sitting there in 2010 and you're looking at the past 10 years, recency bias is probably going to tell you, hey, the S&P 500 is terrible. I should put all my money in small company value stocks. That would also be a mistake. That's also recency bias. So what if we go back to 2000 to 2024, so the last 24 years? Take a look at this chart. Small value stocks were up 1,506% over the last 24 years, and the S&P 500 was only up 465%. What a dramatic difference. And if I take it back to 1927, $1 in the S&P 500, if you could invest in that index, would have grown to $12,785. But in small value, $172,032. Talk about a dramatic difference. So can you see how that human frailty called recency bias can create some pretty bad investing mistakes? It might save us from that tiger, but it's not going to help us make good decisions when it comes to investing. Success requires the exact opposite of that. You need to own stocks in both of those indexes. And in fact, in a lot of other indexes worldwide. And then you need to stick with it regardless of what is hot at the moment. We're playing the long game here. And you need to have a well thought out, well diversified portfolio that you can stick with for the long run. So my name is Rick McCallister. Thank you for watching.